Have you ever wondered how some people seem to effortlessly grow their wealth while others struggle to make ends meet? The answer lies in the power of investing. Investing is not just for the wealthy or finance-savvy individuals. It is a tool that anyone can use to secure their financial future and build wealth over time. If you've ever felt overwhelmed or intimidated by the world of investing, fear not. This beginner's guide is here to demystify the process and empower you to take control of your financial destiny. Setting financial goals is an essential step in managing one's money effectively. Short-term objectives typically involve saving for specific purchases or expenses within the next year, such as a vacation or new car. These goals provide a sense of achievement and motivation in the near future. On the other hand, long-term objectives focus on larger milestones like retirement savings, purchasing a home, or building wealth over several years. They require careful planning and discipline to achieve but offer significant rewards in the long run. Defining clear short-term and long-term financial goals can help individuals stay focused and track their progress towards financial stability. Short-term objectives create a sense of urgency and encourage daily saving habits, while long-term goals require patience and consistency over time. By setting both types of goals, individuals can strike a balance between immediate needs and future aspirations, leading to a more secure financial future overall. Understanding risk and reward is a fundamental principle of investing that can often be challenging to navigate. While the allure of high potential gains can be enticing, it's crucial to balance this with the possibility of significant losses. Successful investors recognize that every decision involves a trade-off between risk and reward, requiring a careful consideration of their tolerance for uncertainty. To effectively manage risk and reward in investing, it's essential to diversify your portfolio across different asset classes and industries. By spreading your investments, you can mitigate the impact of potential losses while still having exposure to opportunities for growth. Additionally, staying informed about market trends and conducting thorough research before making investment decisions can help you make more informed choices that align with your financial goals. Balancing risk and reward is not about avoiding all potential downsides but rather finding a strategic approach that maximizes gains while minimizing losses in the long term. Stocks, bonds, real estate, these are just a few of the myriad investment options available to those looking to grow their wealth. Stocks offer the potential for high returns but come with higher risks due to market volatility. Bonds, on the other hand, provide a more stable investment option with fixed interest payments. Real estate investments can be lucrative through rental income and property appreciation, offering diversification in an investment portfolio. While stocks may seem volatile, they also present an opportunity for significant gains if chosen wisely. Bonds provide a crucial element of stability with predictable returns over time. Real estate investments allow individuals to tap into the wealth-building potential of property ownership and can serve as a hedge against inflation. Diversifying across these different types of investments can help mitigate risk and maximize returns in the long term. When it comes to creating a diversified portfolio, the key is to spread risk across different assets. By investing in a variety of asset classes such as stocks, bonds, real estate, and commodities, you can reduce the impact of market fluctuations on your overall investment performance. Diversification allows you to capitalize on different market trends and economic conditions, ensuring that your portfolio remains resilient even in times of uncertainty. It's important to note that diversification doesn't just mean owning multiple investments. It also involves managing correlation between those assets. By selecting assets that are not highly correlated with each other, you can further enhance the benefits of diversification. For example, when stocks are performing poorly, bonds or real estate investments may provide stability and balance out your portfolio's overall returns. This strategic approach helps in mitigating risk while optimizing potential rewards for long-term investors looking to build wealth steadily over time. Investment strategies for beginners: dollar cost averaging, passive investing. Investment strategies for beginners. Dollar cost averaging and passive investing offer unique approaches to building wealth over time. Dollar cost averaging involves regularly investing a fixed amount of money into the market, regardless of its fluctuations. This strategy can help reduce the impact of market volatility on your investment portfolio by spreading out your purchases over time. Passive investing, on the other hand, involves investing in a diversified portfolio that tracks a specific index or market. This hands-off approach allows beginner investors to benefit from broad market growth without actively managing their investments. By focusing on low-cost index funds or exchange-traded funds, ETFs, beginners can access diverse investment options with minimal effort and fees. Both dollar cost averaging and passive investing provide simple yet effective ways for beginners to start their journey towards financial independence. Conclusion: start investing wisely for future success. It is never too early or too late to start investing wisely for your future success. The power of investing lies in its ability to grow your money over time, creating a nest egg that can provide financial security and freedom. By making smart investment decisions, you can take advantage of compounding interest and market growth to build wealth steadily. Remember that investing is not a get-rich-quick scheme but a long-term strategy that requires patience, discipline, and careful planning. Diversifying your investment portfolio, regularly reviewing your financial goals, and staying informed about market trends are key factors in successful investing. So take the first step today towards securing your financial future by starting to invest wisely and watch as your money works for you over time.